The federal government sets a limit on how much money you're allowed to save if you're on SSI. $2,000. That's it. $2,000. And if you go over that, they start cutting your benefits. That rule was written in 1989. Ronald Reagan was president. A gallon of gas cost 89 cents. And Congress has not touched that number since. Adjusted for inflation, $2,000 in 1989 is worth roughly $8,000 today. The asset limit has not kept pace, not even close. What that means in practice is that over 7.5 million Americans on SSI are legally required to stay nearly broke, or lose the one income source keeping them alive. That is not an accident, it's a policy choice, and today we're going to talk about it. I'm Drew. This is Disability.co. Let's get into it. Before we go deeper, we need to get the foundation right, because SSI and SSDI get confused constantly, even by people who are receiving one of them, and which program you're on determines everything about what rules apply to you. SSDI, Social Security Disability Insurance, is an earned benefit. You paid into it through your paycheck for years. Those FICA taxes that came out of every paycheck, that was your premium. When a qualifying disability prevents you from working, SSDI is the payout. Your monthly benefit is based on your earnings history. No income limits, no asset limits. If you have $1 million in the bank, you can still collect SSDI. The government doesn't care how much you have saved. You earned this. SSI, Supplemental Security Income, is completely different. It's a needs-based program funded by general tax revenue, not payroll taxes. No work history required. The federal benefit in 2026 is $994 a month for an individual. And the rules around what you're allowed to own and earn are some of the most restrictive in the entire federal benefits system. A lot of people receive both programs simultaneously. That's called concurrent benefits. If your SSDI amount is low, you might qualify for SSI to supplement it. And when that happens, all of SSI's rules apply to you. The asset limits, the income rules, the marriage penalties, all of it.
The asset limit. This is the rule that defines the trap.
If you're on SSI, you cannot have more than $2,000 in countable resources as an individual. $3,000 for a couple. Those numbers have been frozen since 1989. The government is telling you that you can save approximately 1 month's rent before they start cutting your check. Here's what counts toward that $2,000 limit. Cash. Bank account balances, checking, savings, all of them combined. Stocks and bonds. A second vehicle. Most property other than your primary home. Life insurance policies with a cash value over $1,500. If the combined value exceeds $2,000, even by $1, you are over the limit. Here's what doesn't count. Your primary home, regardless of value. One vehicle, regardless of value. Household goods and personal effects. Burial funds up to $1,500. And the contents of an ABLE account and assets held in a special needs trust. Those exclusions are the exits out of the trap. What does this look like in real life? It means people on SSI cannot save for emergencies. They cannot build a cushion. The moment they start saving past $2,000, they have to spend it down or risk losing benefits. Spending it down often means buying things they don't need just to get the balance below the limit. This is the system, designed or at minimum tolerated to ensure that people on SSI have no financial cushion, no runway, no margin for anything to go wrong. The political reality. Updating the asset limit requires an act of Congress, not a regulatory change, not an executive order, an actual vote in both chambers. Multiple reform bills have proposed raising the limit to $10,000 for individuals, $20,000 for couples. None of those bills have passed.
The asset limit is the foundation of the trap. But there are several other rules built on top of it that are just as punishing. These aren't rare edge cases. These are things that happen to people on SSI every day. The marriage penalty. If you're on SSI and you marry someone who has income or assets, even modest income, SSA will deem a portion of your spouse's income as available to you. This is called deeming. And depending on your spouse's earnings, it can bring your SSI check down to zero. For millions of people on SSI, marriage to someone who works a normal job is a financially devastating act. They're not choosing to stay single, they're being economically coerced into it. The inheritance trap. A grandparent dies and leaves you $5,000. You're on SSI. You have 60 days to either spend that money down below the $2,000 limit, put it into an ABLE account, or transfer it into a special needs trust. If you don't, you will be over the resource limit. People have been blindsided by this with five-figure overpayment demands. Gifts. If a friend, a family member, anyone gives you money, SSA counts it as unearned income in the month you receive it. $20 from your mom on your birthday? That's income. The system treats generosity as a liability. In-kind support and maintenance, called ISM. If someone provides you with food or shelter without charging full market value, a friend lets you stay rent-free, a parent pays your electric bill, SSA can count the value of that support as income and reduce your benefit. The rule effectively penalizes disabled people for having a support network. None of these are hypotheticals. The system was designed in a philosophy where poverty programs were supposed to be temporary and minimal. The assumption baked into the rules is that recipients should have no resources, no support networks, no inheritance, no marriages to working spouses, just poverty, contained and permanent. Here's what the system doesn't advertise. There are 3 legitimate legal tools that allow people on SSI to save money, accumulate resources, and plan for the future without losing benefits. These are real programs. Congress created them specifically because even Congress understood the trap was brutal. Most people on SSI have never heard of any of them. First, ABLE accounts. The ABLE Act was passed in 2014, a bipartisan achievement. It created a tax-advantaged savings account specifically for people with disabilities. The key rule: money in an ABLE account does not count toward your SSI resource limit, up to $100,000. The annual contribution limit in 2026 is $20,000 per year. ABLE accounts can be used for qualified disability expenses, housing, education, transportation, assistive technology, healthcare. The definition is broad enough to cover most of daily life. Important update for 2026. The Able Age Adjustment Act took effect January 1st, 2026. The cutoff is now age 46. Previously, only people disabled before age 26 qualified. If you or a family member became disabled before age 46, check your eligibility now. Millions more Americans qualify starting this year. Second, special needs trusts. A special needs trust holds assets for the benefit of a person with a disability without those assets counting toward SSI resource limits. A third-party special needs trust, funded by family members through a will or estate plan, is one of the most powerful planning tools available. It requires an attorney to set up properly. Look for an elder law or special needs planning attorney. Third, the PASS plan, Plan to Achieve Self-Support. A PASS allows SSI recipients to set aside income or resources toward a specific work goal, starting a business, getting a degree, buying equipment. We covered this in episode 11. The key point: money set aside in an approved PASS does not count as a resource. The thread that connects all 3 tools: they require knowledge, they require planning, and they require access to professionals who understand the system. The poverty trap is not just the rules themselves, it's the information gap that prevents people from using the exits. Let's be honest about where the reform effort stands. A lot of content will tell you Congress is working on it,
without telling you what that actually means in practice. The SSI Savings Penalty Elimination Act is the most prominent current reform bill. In its most recent version, it would raise the individual resource limit from $2,000 to $10,000, raise the couple limit from $3,000 to $20,000, and index both to inflation going forward. It has bipartisan support, not overwhelming but real. As of 2026, it has been reintroduced in the current Congress. It has not passed. Other proposals include the SSI Restoration Act, which would also reform the marriage penalty and in-kind support rules, and raise the benefit rate to 100% of the federal poverty level. That bill has a significant cost estimate, roughly $61 billion per year. That cost is the primary obstacle. Here's the honest assessment. The SSI asset limit has not been updated in 37 years. The political will to update it exists in pockets of both parties. The obstacle is cost. The obstacle is also that SSI recipients are not a politically mobilized constituency in the way that, say, Social Security retirees are. That is something advocates are actively working to change. What has historically moved the needle? Constituent contact. Not form letter emails. Actual calls and personal letters to your specific congressional representatives. I'll link a direct page to find your representatives and the specific bills at disability.co/episode 13. Here's where we land. The SSI poverty trap is real. The $2,000 limit is real. The marriage penalty is real. The inheritance trap is real. And the tools to work within the current system, ABLE accounts, special needs trusts, PASS plans, are real and underused. Congressional reform is possible. It has bipartisan support in principle. What it needs is sustained public pressure from people who are directly affected, and from the families, advocates, and allies who stand with them. And if you're on SSI right now and you haven't looked into ABLE accounts or special needs trusts, that's the one action I'd ask you to take this week. Start at the ABLE National Resource Center, ablenrc.org. It costs nothing to look. I'm Drew. This is disability.co. We'll see you next episode.